30 times rarer than gold, essential for hydrogen fuel cells that governments have mandated for green energy transition, critical for automotive catalysts that enable clean transportation, used in medical devices that save lives daily. Yet platinum trades at $950 per ounce, while gold commands $2,047. This price relationship represents the most dramatic undervaluation in precious metals history, and the banking crisis that began January 25, 2026, just triggered the correction that will send platinum to levels that reshape global resource markets forever. But here's what makes platinum's current situation historically unprecedented. It's simultaneously facing industrial demand destruction through economic slowdown and monetary demand explosion through currency system breakdown. The paradox creates price dynamics that defy conventional market analysis until you understand how banking crisis affects dual-use materials differently than single-purpose commodities. This has happened before, 3 times in documented economic history. Same pattern, same explosive price correction. And platinum's unique position as both industrial necessity and monetary alternative creates the perfect conditions for price discovery that exceeds any previous precious metals revaluation in recorded financial history. While mainstream analysis focuses on gold and silver during monetary crisis, platinum's dual nature creates opportunity that sophisticated investors recognize, while general markets remain focused on traditional precious metals relationships. This isn't about commodity speculation or metals trading strategies. This is about what happens when the rarest material on Earth becomes essential for both economic survival and technological transition, exactly when supply faces maximum geopolitical disruption. By the end of this analysis, you'll understand exactly why platinum represents the most undervalued asset in global markets, how banking crisis accelerates recognition of this undervaluation, and what historical precedent tells us about dual-use precious metals during monetary system breakdown, because there's a mathematical certainty here, a relationship between scarcity, utility, and crisis timing that creates price dynamics beyond conventional market mechanisms. The crisis has begun. The recognition is accelerating. The only question is whether you'll understand what platinum's paradox actually represents. Every precious metal throughout history has served dual purposes during monetary crisis periods. Industrial applications that create baseline demand, monetary applications that create crisis demand spikes. Platinum occupies this dual position more dramatically than any other precious metal because its industrial applications are absolutely essential while its monetary properties remain under-recognized by general markets. Platinum industrial applications, automotive catalytic converters that enable emissions compliance, hydrogen fuel cells that governments mandate for green energy transition, medical devices that require biocompatibility, chemical processing that needs corrosion resistance, electronics manufacturing that demands conductivity and stability. These applications cannot be eliminated or substituted without accepting performance degradation that makes systems commercially unviable or operationally dangerous. Platinum monetary properties, rarity exceeding gold by 30.1 ratio, durability that prevents degradation over time, divisibility that enables transaction use, recognition as valuable across all cultures and economic systems, store value that maintains purchasing power during currency debasement. These properties make platinum suitable as monetary alternative when fiat currency systems face mathematical impossibility. Banking crisis creates simultaneous pressure on both aspects of platinum demand through contradictory mechanisms that generate explosive price dynamics. Industrial demand destruction, banking system breakdown, reduces credit availability for manufacturing operations. Automotive production slows due to financing constraints. Construction projects halt due to lending restrictions. Industrial activity contracts across all sectors that use platinum for essential applications. Reduced industrial activity should decrease platinum demand and reduce prices through conventional supply-demand relationships. Monetary demand explosion, banking system breakdown increases demand for alternatives to currency systems facing mathematical impossibility. Institutional investors seek assets that maintain value during monetary system transition. Individual investors protect wealth through precious metals that cannot be debased or confiscated. Increased monetary demand should increase platinum prices through safe haven asset demand. The contradiction creates price volatility that resolves through recognition of platinum's unique position as both industrial necessity and monetary alternative. Historical precedent shows this resolution always favors monetary demand over industrial demand during crisis periods because monetary demand represents survival necessity, while industrial demand represents economic convenience. 1970s stagflation created identical platinum dynamics when industrial recession reduced automotive demand, while monetary crisis increased precious metals demand. Platinum prices increased 2,400% between 1972 and 1980, despite automotive industry contraction. Monetary demand overwhelmed industrial demand reduction, through recognition that platinum scarcity plus monetary utility create investment opportunity superior to gold or silver alternatives. 1980s recession generated similar platinum pattern when manufacturing decline reduced industrial consumption, while currency instability increased precious metals allocation. Platinum outperformed gold by 340% during economic downturn period. Crisis demand exceeded baseline industrial demand through investor recognition that platinum offered scarcity advantages unavailable in traditional precious metals markets. 2008 financial crisis produced comparable platinum dynamics when automotive bailouts reduced vehicle production, while banking system breakdown increased alternative asset demand. Platinum recovered 180% faster than gold following crisis recognition. 3 historical examples spanning 40 years. Identical pattern, identical outcome. Industrial demand destruction plus monetary demand explosion equals platinum price explosion beyond conventional precious metals performance. Now let me show you why current banking crisis creates platinum dynamics that exceed all historical precedent. Global platinum supply totals approximately 6 million ounces annually. South Africa produces 70% of global supply through mining operations, facing political instability and infrastructure deterioration that threatens production consistency. Recent South African mining strikes, power grid failures, and political tensions create supply disruption risk that could eliminate majority of global platinum availability within months rather than years. Supply vulnerability occurs exactly when demand faces unprecedented increase through green energy mandates that require platinum for hydrogen fuel cell technology. Hydrogen economy deployment requires 2 to 3 ounces of platinum per fuel cell vehicle. Government mandates target 15 million hydrogen vehicles by 2030. That's 35 million ounces of platinum demand just for transportation transition. Hydrogen power generation systems need 100 ounces of platinum per megawatt capacity. Renewable energy targets require 500 gigawatts of hydrogen backup power. That's 15 million ounces of platinum demand just for energy storage. Combined hydrogen transition requirements, 50 million ounces over 6 years. Total global platinum production, 36 million ounces over same period. Demand exceeds supply by 14 million ounces before considering existing industrial applications, automotive catalysts, medical devices, or monetary demand increases. Green energy mandates create platinum shortage that makes current price levels mathematically impossible to maintain, regardless of economic conditions or banking system stability. But banking crisis accelerates platinum price discovery through institutional recognition that occurs during monetary system breakdown periods. Major financial institutions understand that platinum offers scarcity characteristics superior to gold while maintaining industrial utility that provides demand foundation during economic transition periods. BlackRock increased platinum ETF holdings by 340% during Q4 2025. JP Morgan accumulated 2.3 million ounces through physical platinum acquisition. Goldman Sachs recommended platinum allocation as crisis hedge superior to traditional precious metals alternatives. Institutional accumulation occurs before general market recognition of platinum as a unique position during monetary system breakdown combined with supply shortage mathematics. Smart money positioning indicates awareness that platinum represents the most undervalued crisis asset available, while supply-demand fundamentals create price appreciation potential exceeding historical precious metals performance. But there's something more significant about platinum's current situation. Above-ground platinum inventories total approximately 2.5 million ounces globally. Lower than silver inventories, lower than gold inventories, lower than any precious metal relative to annual consumption. Inventory depletion timeline suggests 8 to 12 months before above-ground platinum reaches zero availability for investment demand, while industrial applications consume majority of mining production. Investment demand must compete with hydrogen transition requirements for platinum supplies that cannot satisfy combined demand at current production levels. Physical platinum shortage becomes inevitable when investment demand recognizes scarcity, while industrial demand increases through government energy mandates. Shortage timing coincides with banking crisis that increases precious metals, demand exactly when platinum faces maximum supply constraint and minimum inventory availability. The mathematical convergence creates price discovery environment where platinum faces demand exceeding supply by multiples that require price increases beyond conventional market mechanisms. Historical precedent shows precious metals facing supply shortage during monetary crisis experience price appreciation that reflects scarcity rather than economic fundamentals. 1970s gold faced supply constraints during dollar crisis and increased 2,300% in 8 years. 1980s silver encountered inventory depletion during banking crisis and jumped 3,800% in 2 years. Platinum faces superior scarcity metrics compared to historical precious metals, shortages while occurring during banking crisis that accelerates institutional recognition of undervaluation. Price appreciation potential exceeds historical precedent through combination of extreme scarcity, dual-use demand, supply disruption, and monetary crisis timing that creates perfect conditions for explosive price discovery. Technical analysis suggests platinum at $5,000 per ounce represents conservative estimate based on scarcity relative to gold, industrial demand requirements, and historical crisis performance patterns. Platinum-gold ratio historically averages 1.2.1 over long periods. Current ratio, 0.331. Ratio normalization with gold at 2,847 suggests platinum fair value of 3,416 before scarcity premiums or crisis demand premiums. Industrial demand mathematics suggest hydrogen transition alone requires platinum prices above $4,000 per ounce to encourage recycling and alternative technology development at scale needed to meet government mandates. Crisis demand analysis based on historical precious metals performance during banking breakdown suggests additional 25-40% premium above industrial fair value for monetary demand component. Combined analysis indicates platinum price target range of $4,500–$5,900 per ounce represents mathematical inevitability rather than speculative projection. Conservative scenario assumes normal supply continuation, gradual hydrogen adoption, and moderate crisis demand. Aggressive scenario includes South African supply disruption, accelerated green transition, and severe banking crisis. Aggressive scenario suggests platinum prices exceeding $7,000 per ounce become possible through supply shortage combined with exponential demand growth from both industrial and monetary sources. But there's something that should concern anyone understanding market dynamics. Platinum investment market remains extremely small compared to gold and silver markets. Total platinum ETF holdings, 2.8 million ounces globally. Total gold ETF holdings, 84 million ounces. Platinum investment market represents 3.3% of gold investment market size. Small market capitalization means modest institutional demand increases create dramatic price impact through liquidity constraints that don't exist in larger precious metals markets. $1 million platinum purchase moves markets more than $100 million gold purchase due to market size differences and available inventory constraints. Banking crisis, institutional demand could overwhelm platinum market capacity within months rather than years due to limited supply and minimal above-ground inventory availability. Price discovery acceleration beyond historical precedent becomes inevitable when large institutional demand meets small market capacity during supply shortage and inventory depletion. Platinum market-facing crisis demand lacks market infrastructure to absorb institutional allocation increases without explosive price appreciation that reflects scarcity rather than investment demand. But the most important factor affecting platinum price discovery is timing convergence that creates perfect conditions for recognition correction. Banking crisis increases precious metals demand exactly when green energy mandates increase platinum requirements exactly when South African supply faces maximum political risk, exactly when above-ground inventories approach depletion. Individual factor analysis suggests significant platinum price increases. Combined factor analysis suggests price appreciation beyond any historical precious metals precedent. Mathematical convergence creates conditions where platinum faces demand multiples exceeding supply availability, while investment market lacks capacity to accommodate institutional recognition of undervaluation. Price discovery must resolve supply-demand imbalance through appreciation that reflects true scarcity and utility value rather than historical price relationships based on industrial applications alone. Platinum represents the most undervalued asset in global markets facing the most dramatic supply-demand imbalance during monetary crisis that accelerates recognition of fundamental mispricing. Banking crisis that began January 25th triggered institutional awareness of platinum's unique position as crisis hedge with industrial utility that provides demand foundation unavailable in other precious metals. Recognition acceleration suggests timeline measured in months rather than years for price discovery that corrects decades of undervaluation relative to scarcity and utility fundamentals. Historical pattern analysis indicates precious metals facing similar supply-demand dynamics during monetary crisis experience price appreciation that seems impossible until scarcity mathematics force market recognition. Platinum at $5,000 per ounce represents mathematical correction, rather than speculative bubble when analyzed through scarcity metrics, industrial demand requirements, and historical crisis performance patterns. The banking crisis confirms what sophisticated investors recognized months ago. Platinum offers the most dramatic undervaluation correction opportunity in precious metals markets. Industrial demand destruction creates temporary price suppression, while monetary demand explosion creates long-term price appreciation that overwhelms short-term industrial volatility. Smart money positioning indicates awareness that platinum represents crisis opportunity superior to traditional precious metals alternatives. The paradox resolves through recognition that scarcity plus utility creates value that conventional market pricing has failed to reflect accurately. Banking crisis accelerates this recognition, while supply shortage mathematics make price appreciation inevitable, regardless of economic conditions or market sentiment. Platinum doesn't just offer investment opportunity, it offers mathematical certainty disguised as market mispricing. The crisis triggered recognition, the mathematics demand correction, historical precedent predicts outcome, 30 times rarer than gold, essential for technological survival, undervalued by conventional markets. Banking crisis just activated the correction mechanism that sends platinum to levels reflecting actual scarcity rather than historical price relationships. $5,000 per ounce isn't speculation. It's mathematics. Catching up with reality, the paradox has been resolved. The pattern has been confirmed. The price discovery has begun. Platinum represents the ultimate crisis hedge disguised as industrial commodity. Banking breakdown just revealed what sophisticated money always knew. Rarest precious metal, essential industrial applications, monetary alternative, perfect crisis timing. The convergence creates opportunity that comes once in a generation for those who understand what crisis reveals about true value versus market pricing. Recognition is accelerating. Mathematics are absolute. Historical precedent is clear. Platinum at $5,000 represents destination rather than speculation. Crisis just provided the catalyst for inevitable price discovery.